It's Tom Aspray with the Market Wrap video for the week ending September 23rd, and quite a week it was. One of the more dramatic weeks since probably the Lehman Brothers in 2008, at least in my memory. A quick look at some of the data will show you this is the weekly data. So 392 issues advancing, 3,088 declining out of a total of 3,564. That was almost a 90% declining issues for the week. That doesn't happen too often. The volume numbers were not quite as bad. They were about 4-to-1 negative, but still extremely heavy selling, and that was reflected in indicators like the ARMS index. Let's look at first at some of the weekly charts. This is the Spider Trust. We can see we had broken that uptrend heading into this week with last week's close. That was a pretty bearish sign. And so far, it's the only AD line that has not broken, below that June low. As you can see, the AD line here for the S&P 500 is still above the June low. Some of my students will notice that the quality analysis I teach in several of my classes, that target has been met. What it does is it takes the distance from this peak to that low, all right, and it says, okay, well, if we have an equal decline to that decline from this low, then the target will be 362.89, and the low last week was 363.29. So we're getting down in there. We're not quite below the Stark band, but we got it real close. The pattern is clearly negative, and we did, get below the weekly Stark band before the late Friday rally. A look at the QQQ shows we had a low last week of 272.02 as opposed to a low of 269.28 in June. So prices did not make a new low. However, the NASDAQ 100 AD line did. You can see it's below this support at line C. That essentially refutes the bullish divergence we've been talking about for some time. And, the oversold here, it's not a good sign to see this moving average start to roll over. Any rally will have to be really powerful to reverse that. A look at the daily advanced decline analysis. Similar picture. You can see we have support here for the S&P 500 AD line. Has held so far. The gap here between the close and the moving averages here, red 20-day EMA at 390, black 100-day at 396.18, and then the 50-day, which is starting to flatten out at 401.58. Stocks only AD line did break to new lows, and as I noted earlier in the week, the NYSE All AD line has been leading the way. It also has broken its bullish divergence support, this line E. That's not a positive sign. Those looking for an oversold bounce shouldn't give up quite yet. You can see this is the NYSE Advanced Minus Decline Oscillator, minus 1774. It was a bit lower in June, but it looks like we should get even a snapback rally back up into the neutral zone. You can see these twin peaks on the way up, started to diverge. Prices moving higher. This was moving lower. We had one last spike there, on that last bounce to the upside, but it got up to plus 1,000. And McClellan Oscillator is also very oversold, minus 376. No signs of a bottom. We had some nice bottoming signals in June and July, but nothing here yet, and it will take time. Based on the QQQ, this is the 1 out of 100 basically, or 1% of the stocks are above their 10-day moving average. You can see past instances, this has resulted in at least a 3 or 4 day bounce. Here was just a rebound in a downtrend. Happened a couple days later. It was pretty impressive. We made it back above the 20-day EMA right here on that bounce. Also back in in January and in March, we got similar sort of rallies. So that should be expected. 20-day EMA, of course, is at 291.48. It's almost 20 points above where we are, and that should be pretty much a brick wall. Looking at longer-term support levels, you can see this S&P 500. The cash chart here shows you, 37.23. We had a 37.36 low in June. We're still above that, but 35.49, 37.23, and then below that we have 32.33, 32.09. Bullish sentiment, fell through the roof again, 17.7. Where this line 1 is, that was a 30-year low, so we're getting close to that. And given last week's action, I would not be surprised for it to even go lower this coming week. No help from the big fund managers. I was thinking they might try to be buying in here, but nope, they're back to 26%. And once again, the S&P 500 AD line, the weekly, is still above that support. If that were to be broken, the next major support goes back to the June of 21 lows. Of course, some of the other markets that are moving things. This is a chart of the 2-year Keynote Yield. You can see it went from 2.6 up to 2.8, and actually I think the spot market I think got actually over 4% on Friday. But pretty much parabolic move. If you think this looks parabolic in terms of daily, let's look at a longer term chart. This is a monthly chart showing you the pretty amazing action. You can see back in 2010 we got to 4% then too. So it's been a pretty rip-roaring ride on the upside. I think that's a two-edged sword, if you will, because up at these levels, 2-year notes are starting to get some interest. Locking in 4% for 2 years is looking attractive to many who are investors. And so, of course, these sharply higher yields mean sharply lower bond prices. So those bonds are getting cheaper and cheaper. And of course, you look at the corporate side, if you know what you're doing, they're all even looking more attractive there. The VIX finally rose substantially, but you can see it got up to 32 intraday on Friday, but closed, 20, just under 30. Still in an overall downtrend here. A bearish trend. Daily MACD histogram is slightly positive, but diverging. Lower highs here, so maybe it'll get to 40, which is some of those resolute bears have to see before they think we can bottom. But I'm not convinced. It's been a market that has not performed the way people would expect it to all year. Those things usually get to take time before they change back. So you can see that markets made lower lows throughout this period. The VIX has made lower highs. Let's go back to the futures, the 260 analysis. So basically you may still be short from that 38.74 level. The targets, all 3 targets have now been met with the action late in the week. You can see we reversed to the upside here in the 260. So, the stop here is at like 37.60, right about up in here. And you can see the 20-day EMA is declining. It's been a pretty good barrier on the upside. It's at 37.88. So, you could potentially get a rally up there and not trigger a buy signal, but we'll be watching it. The stochastic confirmer, is turned positive here, and it's pretty oversold. It's been more oversold, but so that's an encouraging sign. You can see the HTF is bearish. That's because the daily is still bearish. Speaking of the daily, we're still in the negative mode from here on the 14th of September. We've hit 2 out of 3 targets. The last one was at 366663, and the low so far has been 366025. The remaining third target is all the way down here at 3464.83. So once again, it's got a 20-day up here that's really up to 39.96. You can see that we went from yellow declining to blue rising for a couple of days, and that didn't last long, and we reversed back, to the negative side here, and that's where we stand. The stop here for Monday's close will be 39.25.77. Well, that's pretty much all I have for today. As always, appreciate your feedback. Email me if you have any insights on last week's action. And I'll be tentatively planning on doing a session, maybe a more not just Viper Daily people, next Saturday. If so, I'll keep you posted early in the week. Thank you very much and have a great weekend.